Welcome to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build disability and a lifestyle that they love. We're your hosts, Chris and Scott, and we're back at it today, diving into a very important but often neglected and misunderstood part of a financial plan. Would you say, Scott?
We're talking about insurance today. I would say it's a topic that could be not only neglected, but I think it can often just be can be kicked down the road, so to speak. I think a lot of people do this with things like insurance or getting their estate documents done. Like they know that they need to get these things addressed. They know that it's important, but they just haven't gotten around to getting it done.
It's so easy to avoid because just the word is just like cringeworthy for some people, like insurance. It
For
sucks.
sure. And it's interesting. I feel like it's a bit of a mix between just thinking of our clients. I would say it could be almost split down the middle. We feel like we have clients where it's like they're really on top of it. They realize how important the right insurance in place is, and they may come to us already with solid coverage, or they know that they need to address it and they want to get on top of it. Then we also have a portion of our newer clients that come to us and have like a kind of a nasty taste in their mouth and just cringe at the thought of like getting insurance for whatever reason, right? Like, would you agree? Like it's a bit of a mix.
Totally mix. And I think whatever they come with, like whether they come with insurance or not, or an interest in it or a aversion to it, I think the interesting thing to me anyway is that like the majority of the time that these conversations are started, it's because something happened in their lives that made them feel like, oh man, I gotta get my stuff together. Every time, whether it's talking about wills, especially, it's like my uncle died, or there was an estate distribution and I had an inheritance, and it made me realize that, man, I don't even have my estate plan in place. I think it's the same with insurance. It's like, hey, I was talking to a friend of mine that just got diagnosed with a critical illness, or hey, so-and-so just had this temporary disability, and like they were telling me about their policy that paid out, and now I'm ready because I know someone firsthand. Now I'm ready to take action.
Happens all the time.
Yeah.
Today we're going to dive in specifically to the topic of disability insurance. I know there's some different areas of insurance that we'll probably eventually touch on all of them, but today's conversation is going to circle specifically around the ins and outs of disability insurance, the importance of it, what you should be considering.
We need a full episode on this one, right? Like when I in the open, I said most misunderstood. It's not a great awareness. I think disability really falls into that camp. Personally, I know for me, I thought I was pretty financially savvy. I had no idea how disability insurance worked like 10 years ago. It was just something that I didn't need. I felt I had some coverage through my group employer plan, so it was something I didn't have to think about. But I think even as a financial experts, there's so many advisors out there that don't put any effort or energy into disability insurance because it's a complex product. It's hard to get in place, and it's just intimidating for a lot of people. Wouldn't you agree?
It's avoided by most professionals, and if the professionals aren't bringing it up to their clients, then that's often where we see, clients going many years without the suitable disability insurance coverage in place until, like you said, maybe something happens to a peer, or worst case, like happens to themselves, and they realize they're in a position where they're just not very well covered.
For sure. Let's paint a scenario here so we can kind of walk through it together and kind of look at all the different components of disability insurance and what it's made for and what it's not made for, and kind of help our listeners understand. Let's use Dr. Sarah as an example. Let's say she's a 35-year-old chiropractor, so she's kind of early mid-career practice owner and chiropractor in the practice. What else do we want to say about her, Scott?
She's earning a good income. I think in our example, we're saying that she's earning about $150,000 in salary right now. And we're going to paint a picture of like if Sarah, in our example, we're saying that Dr. Sarah is an avid CrossFitter, and she went to the gym one day, was doing some overhead shoulder presses or something like that. And then pop, she heard something go in her left shoulder or something like that. And, soon finds out that she like tore a rotator cuff and she's not going to be able to work for 6 months. And 6 months might not even sound like a long time. Like there's obviously situations where you could get hurt or sick and be off work for a lot longer than that. But, even if we just think of a small level, like you're off work for 6 months, and in this case, we're just going to talk about Dr. Sarah. What kind of coverage should Dr. Sarah have ideally in place to best protect her and her practice?
And I mean, you jump straight to coverage, but like I think in my mind anyway, the first question I would ask is like, how long can your life and your practice keep running if you all of a sudden had no paycheck tomorrow?
That's right. Yeah, we always say like you're the engine. You're the engine that runs everything, right? Cash flow is going to stop if you can't go into your practice and continue to do what you do. How long can your practice hang on for without you bringing in that revenue? How long can you go without paying yourself a steady paycheck? It all hinges on the fact that you can go to work and keep working.
Exactly. Let's keep it super high level here, Scott. But Dr. Sarah hurts her shoulder and gets diagnosed, torn rotator cuff, whatever. Doctors say 6 months, no work. And this happens on the weekend. And then come Monday, what happens on Monday? Does she get disability coverage on Monday?
Well, it depends on the policy that she has in place. So this is where we could dive in right now and just talk about from a high level,
Super
the
high level.
components of the coverage.
Should disability coverage pay out on day one?
In
Probably
most
not.
cases, no.
That's probably where we want to see Dr. Sarah have like an emergency fund in place, probably some buffer in her corporate accounts as well as her personal emergency fund that she could survive probably about 3 months worth of no income.
Typically speaking, a professional level disability contract, and we're going to get into the nitty gritty of what that means, they're considered long-term disability contracts. If you're off work and you sprain your wrist and you can't adjust for 6 days or something like that, you should be able to have, the cash flow on hand to get through a short period.
Yeah.
6 days is obviously a very short period, but even if it's a temporary period of time, like 6 months, can you get through that initial 2-3 months with some cash reserves?
It's not meant for a short term, I missed 4 days of work. It's meant for the longer term thing that's going to keep you out for months and months. I guess the question, the next kind of where I want to go with this is like exploring this whole idea of our earning potential. I think that's the best way to understand the risk that we're insuring through disability coverage. But I think we should start there before we get into the nitty gritty of how it all works and what it is. Because again, I think this is totally a misunderstood concept as well. So tell us about lifetime earning potential and why we use that analogy when we talk about disability coverage.
When we think from a big picture, when we're thinking about our financial plan first and foremost, like we always say, it's always fun and exciting to talk about the growing wealth side of our financial plan and growing our assets and investing. That's all very exciting. But then there's also the defensive side of your financial plan, which requires insurance. And when we think about us, we need to think about us as an asset. Like we are our biggest asset at the end of the day. And that comes in the form of our earning potential over our career. We might think our biggest asset is our house or the value of our practice or what I have built up in my investment accounts, whatever the thing is, right? But at the end of the day, I would argue that probably all those things pale in comparison to what your lifetime earnings are as a chiropractor.
In Dr. Sarah's case, let's say, go back to her scenario. We assume she was earning $150K a year. She's in her mid 30s. So let's say she's still got like 30 years of career ahead of her. She loves what she does and she wants to keep working well into her 60s and doing it. Let's say she increases her salary with inflation over the years. Like she gives herself just steady pay bumps to keep up with inflation. What is our guess of her lifetime earning capacity over those 30 years?
So Dr. Sarah, 35 years old, earning $150,000 a year and having a 3% inflationary increase on her salary, which is very modest. That would be kind of bare minimum in terms of seeing her salary increase over that period of time. But just with inflationary increases, she would earn a total of about 7.1 million in career earnings over that 30-year period of time between 35 and 65.
Very significant earnings.
I actually ran one other example of what about something that's a long period, 30 years. And obviously we're thinking worst case scenario, if you couldn't work for a 30-year period of time, that has to take a pretty severe disability or illness to take you out of work permanently. But say it was a pretty significant injury and you couldn't work for 5 years. In Dr. Sarah's example, over a 5-year period, that's still over $800,000 of earnings in that 5-year window from called 35 to 40 for her.
Big numbers either way, whether it's a disability that takes you out for 30 years or takes you out for 5 years, we're still talking about a significant dollar amount. From our perspective, I think we like to show this illustration so that clients understand the impact of disability coverage, right? It's much
Uh-huh.
easier with other coverages, say life insurance. It has a flat amount that pays out if you die. That's how it works. Like with disability,
Uh-huh.
there's many components and it's hard to know, but just going high level, big picture, it's like if you had the ability to produce $7 million in earnings over the next 30 years, would you insure that asset?
Hey, before we keep going, if you've been listening and thinking, I could really use some clarity around where I truly stand with my finances, we've got you covered. Take our free financial clarity assessment. It only takes about 5 minutes, and you'll get a personalized scorecard showing exactly where you're strong, where you might be spinning your wheels a little bit, and where to focus next. You can head over to alignwealth.ca or just hit the link in the show notes. All right, cool. Back to the show.
Okay, so we've identified that our income is our most valuable asset. So how do we
Yep.
protect it with disability coverage? Take us through the components of a disability contract.
All right, let's start with the very basics. We're going to get into kind of what we view as a professional level contract. Let's just start with the three kind of basic components of a disability contract. First and foremost is going to be your disability benefit amount. Based on someone's salary or their net earnings, they would qualify for a certain monthly benefit, and we'll refer to this as like your net monthly benefit. This would be your disability benefit if you were to go on claim, how much you'd receive on a month-to-month basis, net in your personal bank account. So that's component number one. Number two would be the waiting period that you have to wait through in order to start receiving your benefit amount. So like we said, like if you're going to be off work for only a short period of time, a couple weeks, most waiting periods, the industry norm for a professional level contract is 90 days. So that's what we kind of say, like you need to have at least 3 months worth of cash reserves set aside to make sure that you can get through that initial waiting period. There are options out there where you can get a shorter waiting period, be that 60 days, 30 days, maybe even 0 days. But the shorter your waiting period, typically speaking, your premium's going to go up significantly. And then lastly would be your benefit period. So if you were to go on claim and you're receiving your monthly benefit amount after you've fulfilled the waiting period and now you're on claim, how long would your benefit pay out for is determined by your benefit period. So the two most common benefit periods that we see in a professional contract are to age 65. So that's like worst case scenario, you're hurt or sick and you can't work permanently. Your benefit period, your benefit amount would pay out month over month until the age of 65. Another common option that we see is a 5-year benefit period. So that benefit would pay out monthly for a maximum of 5 years. The unfortunate thing there is if you get to that 5-year mark and you still can't work, you still can't be a chiropractor, your benefit is going to stop at that point. And then you need to revisit basically what your options are.
Okay, so let's just use a typical, like a normal scenario that we would see for Dr. Sarah. So she's earning 150,000 a year. That's about 12,500 a month. As far as the benefit amount, she's likely going to be around 70% of that total as a maximum for coverage, correct? So
That's
about
correct.
$150 per month of coverage is what she could qualify for.
Correct.
And if we assumed a standard elimination period or waiting period, that would be a 90-day. So after 90 days of being disabled, benefits would kick in, and she could elect to have those benefits for either a 5-year period or to stay with her all the way until she turns to age 65.
Yep, that's right.
Cool. What else do we need to know?
That's it from a bare bones standpoint. Like the things that we look at if we're reviewing someone's contract, or if Sarah came to us and said, hey, is this contract going to be suitable based on what I need coverage for? Those would be the things that we look at first. Benefit amount, waiting period, benefit period. But then we also want to get into what's the quality of this contract? What I mean by that is like, how is disability defined in your contract? Most professional level contracts will have a definition of disability. What we'd like to see at bare minimum is what's referred to as a regular occupation definition, meaning that if you go on claim for an injury or illness, as long as you cannot be a chiropractor, you will receive your benefit amount. In contrast, where we don't want to see, which we often will see in like a lot of group disability insurance plans, is that will look different from a definition standpoint. It'll say something along the lines of an any occupation definition. It might be a regular occupation for the first 2 years. What that basically would mean is that for the first 2 years, if you can't be a chiropractor, we'll pay out your benefit amount. But after that 24th month of being on claim, if you can go do any occupation. Typically, they might say, like, based on your skills, education, and training, even if it's at a lower salary or a lower income, you got to go do that now, and your benefit's going to stop. As you could probably tell, can become quite a gray area at that time.
Yeah, definitely important to understand the definition of disability in your contract or policy. And I think that comes up that we look for when reviewing these contracts is residual benefits. Hey,
Yes, residual disability benefits is oftentimes baked right into a professional level contract. Sometimes it could be layered in as a kind of an extra cost or a rider to the policy, but residual is a really important addition to your policy. And what that basically means is that whether it's whether it's at the beginning of a disability or at the end of a disability, often someone will be hurt or sick, and at some point they can get back to work, but maybe they can't get back to work 100% full-time hours right when they're recovering from their disability or illness, right? What residual allows you to do is, okay, I'm recovered, I can get back to work, but I can only work about 50% of the hours that I was working previously. So just hypothetically, I can only earn about 50% of the income that I was prior to my disability. How that would then work if you have a residual disability benefit rider on your policy is that you could keep collecting 50% of your disability benefit while earning 50% of your income.
right.
And that can slowly phase down to once you're back to 100%, then your disability benefit stops.
Or no pressure essentially to return full time to work or losing your disability benefits if you return to work in some capacity. You can do both.
There may be a situation where you never are off work completely. Maybe it's a type of injury where it's like, I can keep working, but because of said injury, for example, I can no longer work, 25 or 30 hours in practice like I typically have been. I have to do only about 10 or 15 because that's what my body can handle. And at that point, right from the get-go, you'd be eligible for a residual disability benefit plus whatever income you can earn additionally.
It's a good point to make. It's not always the big things that can wipe out your financial independence. It can be the little things that prevent you from working, the full schedule that you were previously. Yeah. Let's say for the sake of argument, we've dealt with Sarah's personal needs, right? So have only so far talked about Sarah's salary that she pays herself personally, that 150K a year. And we've talked about disability insurance for her as an individual. But we mentioned in the opener that she's also the practice owner. She might have some other practitioners. She's got her CAs and maybe an office manager or something like that. Maybe she's got massage or multidisciplinary practice. If she is also running the practice on top of her own chiropractic responsibilities, what would happen then if Sarah can't fulfill those duties of running her business?
Yes, this is a common situation that we'll see some docs in where they potentially have a good personal disability policy in place, but they are still running a practice. When you're running a practice, that comes with overhead expenses that don't necessarily just stop because you're away from the practice for either a short or long-term period of time. That's where business overhead expense disability insurance coverage can play a big role in bridging that gap, especially kind of a short-term disability where you may only be away from your practice for, say, 6 months in, say, Dr. Sarah's example, where she could be claiming on a personal disability policy. But if you have what's referred to as a business overhead expense policy or a BOE policy, that can cover a certain percentage, whether that's 25%, 50%, up to 100% of your fixed overhead expenses. That could be your utilities, that could be your salary for your CAs, you name it. Like there could be a long list of different expenses that you could group into there to say, hey, I'm not in the practice for 6 months. I'm not bringing in that revenue, but my staff can stay employed. I can keep paying their salary. All the bills will be paid. And say you are a multidisciplinary practice, everyone can continue to go to work and the bills will be paid.
So essentially, it just is going to buy us some time to recover and kind of support the practice.
The only thing I'll say that's a little bit unique about business overhead expense is that typically the waiting period is a little shorter. Typically those are a 30-day waiting period versus a 90-day. The benefit period is usually one of two options. Either it's a 12-month benefit period or a 24-month benefit period. That particular type of policy, usually the premiums are a little bit less because it's designed to say, hey, this is for a temporary 1 to 2 year disability at most. If it's going to be longer than that, that's probably where you're going to be thinking about other alternatives of how your practice or your business would carry on without you if you're going to be out of the practice for an extended period of time above and beyond 2 years.
That's something where you could look at selling your practice potentially, or moving on from the business component of it personally.
You're just replacing yourself with a full-time associate while you're away from work.
Okay. So you've already mentioned some of this stuff, but like we should review it again in a bit more detail. Specifically around what does good coverage look for chiropractors? What do we look for? What should they be looking for if they have a policy in place already? Let's run
Mhm.
through some of the details.
In Canada, there are a handful of options in terms of what you could consider for disability insurance.
Pretty small handful, right?
A pretty small handful. There's going to be two different kind of sides of disability insurance. What we prefer our clients have is what we again refer to as a professional level contract. And right now in Canada, there's only two carriers that offer new contracts to chiropractors. That's Canada Life and RBC Insurance. Up until about 3 years ago, Manulife Insurance was also providing professional level disability coverage to chiropractors, but they exited out of that market completely. Now there's only two carriers. They're not the only two places that you can get disability insurance. There's other carriers out there. Let's refer to them as maybe kind of B carriers. They offer disability insurance, but typically the definitions of disability aren't quite as strong. Contract itself is just not a very strong contract, and you usually pay a lot more because it's easy coverage to get. It's easy to get through the underwriting process. But what I often will see when I review this contract is say, if someone was actually to go on claim, something serious were to happen, I don't have a whole lot of confidence that this is going to pay out what you think it's going to pay out and for as long as you wanted to pay for as well.
Yeah, good point. I mean, to oversimplify that, what I've always thought is if you don't have disability in place through RBC, Canada Life, or maybe Manulife, you probably don't have as strong of contract as you could, right? And you probably want to consider reviewing your options and seeing if you want to get a better contract in place.
And what's even a bit more interesting when it comes to chiropractors specifically and what their options are, like we said, Canada Life and RBC Insurance are the two carriers right now that offer a professional level contract. But even then, between the two carriers, interesting enough, RBC has a bit more of a favorable insurance rate for chiropractors than Canada Life. Both contracts are very strong. I would take either of them in a vacuum, but from a premium standpoint, RBC favors chiropractors in terms of how much they charge for that coverage. So even more so when we meet a chiropractor that they don't have their coverage through RBC and say it is through Canada Life, we'd say, well, maybe you could also save some money by transitioning over to RBC and paying less for an equally strong contract.
Yeah, without getting into the weeds and the definitions and the lingo in the contracts, it's pretty straightforward. If you don't have a disability policy with RBC, you probably want to consider it. No
For
plug
sure.
for RBC.
Yeah, this is not a plug for RBC. When it comes down to it, what we mean by these professional level contracts, I break this down a little bit in terms of what that contract means. Not only are they stronger definitions, but they're also referred to as what's called a non-cancelable contract. And when I say non-cancelable, you might think like that doesn't sound very good. Like I can't cancel the contract. Is this a bad cell phone contract that I'm locking into and can't get out of, or a bad gym membership? It's not that at all. What non-cancelable actually means is that in order to get the policy in place, you have to go through both medical underwriting and financial underwriting to get the policy approved and enforced. But once that policy is approved and enforced, that contract is essentially guaranteed to you until you, as the policy owner, decide to cancel that contract. That's what it means by when we say non-cancelable. The carrier, the insurance carrier, can't make changes to your contract or change how much you're paying in premium. The contract is the contract.
Yeah.
I've met chiropractors who are now maybe in their 50s or 60s that got a disability contract like this in their 20s when they got out of school, and they had that exact same policy with the same definitions, the same premium that they paid all the way through their career for that certain portion of their disability coverage.
You would want that because these insurance providers can change the rates that they charge for coverage at any time, right?
Yeah.
If all of a sudden RBC deems chiropractors as a bigger risk, and more similarly to how Canada Life treats the risk level with disability for chiropractors, all of a sudden their premiums could go up. If you have a policy in place, your premiums don't go up. Those have been
Correct.
locked. It's non-cancelable, guaranteed premiums. But if you're a new chiropractor going to apply and RBC has deemed the risk higher, premiums are higher, it is what it is when you pay.
That's right. There's a lot of merit then from that standpoint of getting a good chunk of your coverage in place when you are young, have your health on your side. You lock in that certain portion of your income in the form of disability insurance and that premium for the entirety of your career. Like for my own personal example, like I've had my original disability policy that I have in place for myself, I took out when I was 24. And at the time, like when I was 24, that initial disability premium that I was paying felt like a lot. But now as a near 40-year-old, that premium looks like nothing compared to what it would be today for that same amount of coverage. But that
Right.
premium and that contract is locked in for myself as it would be for anyone who gets a professional level contract at any point of their career.
Question for you with that. Say I'm a new grad and I get disability in place as soon as I graduate chiropractic school, and my salary or compensation is quite low when I start out, but I have this policy in place. Do I have any options within that policy, or could I have options within that to increase my coverage as my earning grows?
Great question. Typically, if you're a new graduate, I know RBC does this. I believe Canada Life does it as well. But usually for new grads, usually they can issue at least a $2,500 a month benefit for a new grad without any sort of income verification at all. Obviously, you could get more if you could verify an income that would warrant, say, a $3,000 or $4,000 a month benefit coming out of school. But a nice thing that you could add on to your contract is what's called future insurability option, or the short term is FIO, which basically allows you an option each year to increase your coverage as your income goes up, but with the caveat being that you don't have to go through the medical underwriting every time you want to increase your coverage. So as long as you have the
See,
financial increase in income, you can qualify for a bump up in disability coverage. What I will say there is that every time you bump up that coverage, say you add on another $1,000 of coverage and you're now, say, 2 years older, that premium for that additional $1,000 of coverage is going to be based on your current age at that time. Your previous coverage that you got in place 2 years earlier would still remain intact and the same.
you're just paying a new premium on the additional coverage you have. And you can get that coverage by proving that your income's gone up, but it has no bearing on like your health condition. You don't have to prove that you're still healthy and have no ailments or issues going on.
That's right. And that could be, and when we say like health and ailments, we don't necessarily just bring that up in the fact that you might have a health issue where you get completely declined for coverage. But say you had some sort of sporting incident or you're playing hockey and you took a bad hit and you really messed up your shoulder. If you didn't have that option and you go apply for coverage, they might say, hey, we're going to approve you for disability insurance, but your right shoulder, maybe had surgery on it or you're rehabbing it still, the carrier might say there's some additional risk there with your shoulder because of that injury. We'll approve you for coverage, but any sort of disability related to that right shoulder, for example, is going to be excluded from you being able to make a claim on. If your base policy has that option year over year, even if you get that ailment in the future, they can't exclude anything in the future from a health standpoint, which can be really valuable if something does happen that's impactful like that.
Hugely valuable. Just assuming health conditions are non-existent and everyone stays healthy and active and all is good. Just the concept that you can easily increase your coverage as your earnings grow without going through a whole lot of hoops, like that's a huge benefit in itself. Then you factor in the fact that there could be something that happens between the time you initially get your contract in place and over the 20 or 30 years of your career, where you're adding new coverage in without having to go through that medical underwriting. All right, let's talk about how we pay for disability coverage, because this is like a component in itself almost these days.
We'll try and keep it super high level, at least for this podcast episode. If you want personal disability insurance, your best route to go is to have your personal disability policy owned and paid for personally from your personal bank account. What that ensures is that if you were to go on claim, that benefit amount that you do receive is received as a tax-free insurance benefit.
Going back to our example, the $8,750 monthly benefit amount, approximately 70% of Dr. Sarah's $12,500 of earnings per month is paid to her bank account tax-free.
If Sarah personally owns and pays for that contract with after-tax dollars.
Cool. There is the option to pay for it corporately, but then you're paying tax on those benefits when you receive them.
Paying for it corporately comes with a few complexities. Say, for example, Dr. Sarah had a spouse or a partner in her practice, and they both required disability insurance. Carriers like RBC and Canada Life, for that matter, they'll allow you to set up what's called a wage loss replacement plan. It's a definition that's deemed suitable via the CRA to say that you need to have at least 2 employees under a wage loss replacement plan to be able to legally set up at least 2 disability contracts to be owned and paid for by corporation. But in that case, the premiums would be deductible through the corporation as an expense. If you were to go on claim, that benefit that you receive, since it was being paid for by the corporation, is going to be considered a taxable benefit. In that case, they would receive the $8,750 per month, but she'd probably lose 25-30% of that to taxes.
Makes sense. Personal disability is there could be some options there, but typically, like you said, if you can pay for it personally with personal dollars, it's going to equal a tax-free benefit to you if and when you ever use the benefits, which is probably a pretty good option for sure. Okay, and then business overhead expense, that one's a little bit more straightforward, right?
Because it's covering your business expenses, business overhead expenses. Typically speaking, that policy is always owned and paid for by your corporation. It's a deductible expense. And obviously the income that comes in is going to be it's taxable income to the corporation, but it essentially offsets because you're using that income to pay for expenses that are deductible. That one's pretty straightforward.
All right, Scott. So we've done a pretty good review of disability and business overhead. Let's jump to common objections because we hear them often. I mean, like you said, there's some people that come in with putting a lot of value on insurance and other people that come at it from a different perspective of like totally undervaluing it. I think the biggest one with disability that I've heard is that it's just flat expensive.
For sure.
What would you say to that?
It's easily the number one objection. I've got, the amount of times I've met a chiropractor, I mean, like I've looked into this before in the past and I saw the premium and I thought it was too expensive, so I didn't proceed with it. Completely fair. And I think in a lot of those situations, the professional that's supposed to educate you on the importance of disability insurance, how that contract works, probably didn't do a very good job of explaining why you should consider paying a relatively high premium for that coverage. When we think about, say, for example, term life insurance, for a typical, like, say, 30, 40-year-old, they're looking to get, say, $1 million of term life insurance. We're talking like $30 or $40 a month. Very affordable. It's super cheap. No one ever has any pushback on paying for that coverage, right? But then they start seeing like anywhere from like $100 to up to maybe even up to $600 a month disability insurance premium. And they say like that's a big chunk of my monthly cash flow. And they typically will often relate that to like, well, what's the benefit amount? Like I'm only receiving, say in Sarah's case, $8,750 a month in benefit for say a $300 a month premium. That doesn't seem worth it. But if we do our jobs of saying, let's explain what this could look like if worst case, like what's the worst case scenario? You're off work for a long period of time, 5 years, maybe permanently. What does this do to your financial plan if you can no longer go to work? We talked about you're your biggest asset. We've talked about your earning potential. If that's not reason enough to say, hey, what would happen if I was off work for 6 months, 5 years permanently? How would that impact me? Right?
Yeah, it's pretty crazy to see how fast a plan can derail with a couple years of missed income.
For sure. General rule of thumb that I like to use when it comes to costs, like I would say for most people, like obviously it varies on the individual for a few different reasons, but for most, you'd probably fall from a premium standpoint. You're probably looking to spend somewhere between 1-2% of your gross income on your disability insurance coverage. For some, that might sound like a lot to spend 1 or 2% on a premium to cover, call it maybe 70 to 80% of your income. In a worst case scenario, might be worth shifting that risk over to an insurance carrier. The other little point that I always make when people say it's really expensive, say, well, it's probably expensive for a reason. And that's because these carriers are paying out a lot of claims. Like I bring up Manulife and how they got out of the industry 3 years ago. Do you think they got out of the industry because they were making a ton of money on disability insurance? And no, they actually got out of the industry because they were just paying out too much in disability claims and they couldn't make it a profitable side of their business. They just decided to exit, right? Yeah. That's why there's only 2 carriers that offer it.
Yeah, I don't know any insurance or financial institutions in Canada that would run away from a money-making component of their business. Okay, so what do you say when someone comes and says, "I'm healthy, like I'm Superman. I don't need disability coverage. I take care of myself. Never had any health concerns."
I think it's way more typical with men than it is for women, first and foremost. Like,
yeah, we're Superman.
Especially young men in their 30s and 40s, we're invincible, right? Nothing's going to happen to us. We can grit and bear through any sort of little thing and keep doing what we're doing. But there's so many what ifs, right? There's 1,001 ways you could potentially need to go on claim. The reason why you may go on claim could be something that you've never even considered, like particularly on the illness side. You truly never know what could happen in life. And if you do truly think that way, you may also have never had a firsthand experience of someone close to you, be that a friend or a family member or a peer in the industry, gone through that experience of experiencing a major disability or illness and having, that sigh of relief knowing that they did have the right coverage in place.
I guess the other thing I would add there is that when you're healthy is exactly when you want to get all your insurance coverage in place. It's when underwriting is the easiest and you're going to get fully covered. If you have a condition or, physical ailment or something that's going on, we mentioned earlier, that might be fully excluded from coverage in this case in your disability contract. So anything related to that rotator cuff injury that Dr. Sarah had from CrossFit, she's just not going to get covered for that potentially if she re-injures that and is unable to work.
Which makes me think of a lot of situations where we'll have someone that has an ailment like that get kind of frustrated that they do take the time and have decided, I'm going to move forward with getting a disability contract in place. And then they find out they're going to be excluded for the thing that in their mind they're worried about most because it's top of mind. They've had a recent injury, illness, say for Dr. Sarah to her shoulder, and now her shoulder is excluded from her contract. She might say, well, this policy is useless now. That's what I'm worried about, is not being able to work because of my shoulder. But that's just one of so many different reasons and ways you could potentially utilize that contract from an injury or illness standpoint.
We're just not very creative in our thinking when we think of it like that scenario. It's like, I hurt my back or I hurt my shoulder, so I need to get disability coverage in place. Then they exclude the back or the shoulder from your coverage. And you're like, well, man, now the policy's no good. No, the policy still insures the 999,000 other ways you could become disabled and unable to work. It just excludes that one. But we just get so focused on that one thing, and we see it all the time. One other thing I want to bring up that we didn't talk about before, but just to kind of wrap us up here, that actually one of our clients is mentioning to me this past week, is that when they started in their profession, they just kind of stopped doing some lifestyle things because of the risk. In this example, it was skiing and snowboarding. They used to be avid, skiers and snowboarders and go to the mountains, a few times a year. They just stopped completely because they're like, oh, it's not worth it. I can't afford to get hurt and be out of work, and I need my body to work. And so they recently got some professional level disability coverage in place with us. And all of a sudden they mentioned that, hey, we're thinking of going, like, hey, Chris, we know you're a skier. Like, we're thinking of going to the mountain this year. Like, it just came up that like they had never thought about it for the last 10 years because they hadn't addressed the risk. They just said, we just won't do that anymore. Now that they have the coverage in place, they're like, we used to love this. Let's go try it again. It's just a cool kind of outcome of the confidence that you can have by knowing that you have the appropriate coverage in place.
Whatever your thing is in life that you enjoy, even if it's a bit hazardous in some cases, having the right coverage in place can make sure that you can continue to live your life and do what you want to do. So I love that story.
And good example of, I think that kind of sums up why we do what we do, and that from very high levels, we want to see all our clients doing what they love, and whether that's hazardous or not, like being able to really get the most out of life and enjoy it in a way that they find their passions and explore their lives. So yeah,
for sure.
All right, let's leave you there. Hey,
in terms of like takeaways from the episode, I'd probably just say, like, if you don't have disability coverage in place right now, it doesn't have to be us. Like, if you have a professional that you can lean on that can help you with this, go talk to them, make sure that you have the right coverage in place. If you have coverage in place, after listening to this episode, might be a good time to review the coverage that you have to make sure that what you have in place is suitable. And of course, if you have any questions or would like to chat with us further about that, our door is always open too.
Yep. Awesome.
Okay.
Cool. Well, thanks for listening, everyone.
Yep. We'll see you next time.
Yep.
All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.